Milind Barve, Managing Director of HDFC AMC, joins us to talk about the new offering, which is a debt fund. It is a cancer cure fund and it is a CSR initiative because the AMC does not make money. Do you think there is enough demand for such a product?
Actually, there is, because this is it is a investment product, but it is really structured for philanthropy, and in that sense, we think it's a unique and first of its kind. The intention of the product is really that any philanthropy and NGOs who work in the philanthropic field, they need sustainable revenues of what money that's available to them over the next 2 to 3 years to structure a program which then helps or provides financial assistance for the cause that they do. And when we spoke to the Indian Cancer Society, we actually thought the best way to do it is to actually create a fund, because it's most tax efficient, where the money gets pooled in a debt fund, which is principal protected. So at the end of 3 years, you get the money, the principal money back. And the income that the debt fund would have generated goes as a donation. The investor signs it off as a donation to the Indian Cancer Society. So actually the first fund is coming to an end on 10th of March, and to coincide with that, we are doing another fund, encouraged by the fact that the first fund has really done very well in terms of its objective, which is not really getting the highest return, but giving the income for a philanthropic cause. In a way, Nikunj, we are blessed that our customers are people who have money. And our job was therefore to convert investors into donors. And you'll be surprised about the very enthusiastic response we get from people. And we feel just good about being a good corporate citizen, doing what we did. And we've been doing this 3 years back, much before the CSR guideline was probably talked about. So it's not about us, it's about the cause that we are doing. It's about what we believe every company, every institution should do it. Simply because as you work on any of these sort of issues, particularly on health, it's just mind-boggling. The combination of poor health and poverty is just devastating, and I think no amount of money is enough to sort of do it. So we're doing something which is small in a way for the cost that it kind of tries to help, but we feel good about the fact we don't charge any money. There are no investment management fees. All the distribution cost and the publicity cost is borne by us. But in this fund, we are doing a step more. What we are doing is, for whatever donation that this fund will create, HDFC Mutual Fund, AMC, will make a matching donation of an equal amount, up to about 5 crores, that will look to kind of really more than double the scale of this program. For example, the first fund created donation of about 13 crores over 3 years. And it's funded about 600 patients. So this time we're looking to probably more than double the whole scale of this program, working with the Indian Cancer Society.
Mr. Barve, any NFO is also subject to market conditions. So let's talk about flows. Let's talk about what an average retail investor or general investor is doing. It's a problem there.
That's right. This is a problem if you look at mutual fund as only equity. But right now, as I was mentioning to you, our industry AUMs are all-time highs. And right now for retail investors, clearly the products which seem to attract attention, in a way rightly so, given the time of the year, are fixed maturity plans. So that's actually getting a lot of connect with investors, and that AUM of the industry, which is about 1,30,000 crores, would probably be at 1,80,000 crores by the end of March. So we've seen some good sort of traction amongst investors in certain products at current points of time. But having said that, people are, if you look at the data on equity AUMs, it's true that year to date the industry is probably down net redemptions of about 9,000 crores. But if you look at the numbers, they're indeed small, but they're actually positive for the last 4 months. So I don't think we are seeing just a one-way move out from investors. People are certainly a fair bit, I would say, on pause. Obviously we have a big event coming up in May.
So have redemptions stopped? That's the big question.
Yes, I think redemptions have clearly tapered off significantly. If you look at the month of October, there was the highest redemption of about 3,500 crores for the industry. It's understandable, because in that 1 month the market went up by about close to 9%. So we have movements in markets which are broadly sideways. We are not seeing people really decisively take money off. There are a lot of conversations and engagements with distributors and investors on what they should do, particularly pre-election and post-election and so on, which is understandable, because at the end of the day that event does drive and would drive sentiment towards equity as an asset class.
So what would significantly and meaningfully change sentiment, and would we have to do away with first the elections and only then with retail come into the market?
I would be lying if I say election is not relevant. It is. That's because it makes sort of makes the case for equity as an asset class for the next 2 years. Would you say that an election outcome would change the GDP growth for 2014, March 2015? Probably very little. So probably the election outcome is relevant from predicting the trajectory of growth more for FY16 than so much of FY15. But having said that, who can deny the fact that retail investors do need a view about what is likely to happen, and they're willing to wait for 1 or 2 years ahead if they feel that the configurations of parties is something that can deliver them decisive policies on various sectors. And if you put that together, then people will feel much more confident about the future. And that's undeniable. I mean, it's true that it won't have an immediate impact on, say, the June quarter GDP or the September quarter GDP. But it does give people a view about, and their own view, and it could vary from individual to individual, about what they should expect in the future. And I think it's fair that they think like that.
There's an old maxim on Wall Street that good news and good prices, they don't come together. Right now the news is bad. Are prices good? What is your take on market valuations? Because what is growing is IT and pharma. That is already expensive. What is not growing is cyclical and banks. They're cheap.
Well, that's true. The cyclical and the bank stories are pretty well spoken about. They're obvious because those are fairly deep in value. There are challenges with banks, a number of banks, which nobody denies. The fact is that the question really is for us as in fund management is whether all of that is in the price.
What is your sense?
I think it is in the price. I mean, that's our broad take, that we're not trying to say that the problems facing the banking sector are going to go away very soon, but I think the market is giving, in a sense, punishing those share prices with some very deep cuts in their valuation. So there is a view, and we think it will play out over time, is that while bank performances will recover maybe slowly, the bank's share price performances might recover a little faster.
So is it time to start nibbling into PSUs or still stay away from them?
I wouldn't like to take like a broad sector call. I mean, that sector is not really completely homogeneous. There are banks which are fundamentally very strong. I mean, you'll find people lining up outside their branches to place deposits. So there is that confidence in the stability of the banks. In India, we have a history of no bank failures. So beyond a point, yes, the banks should recover. I think the discussion and debate is more on, as I said, is it in the price, and how long do you think the recovery is going to be? What's the trajectory of the recovery over the next few quarters? And do we see signs of that recovery coming through in the next few announcement of quarterly results?
But as a house, you've been bullish on PSU banks. I was looking at your portfolio. I quite actively monitor your portfolio. Long PSU banks has been a overweight trade. Are you slightly worried that trade has not worked, or that investment has not worked?
I think we are patient with the calls that we make.
Okay.
We have to be patient with a team which has delivered such high quality performance consistently for long years. It would be fair to me to say that yes, that large call of being overweight in banks or in probably believing in the economic recovery has not come out right. But having said that, since probably the June quarter, we've had a very deep down look at our portfolios. We've changed some of our tactical calls. And if you look at our performance in some of our frontline funds for the December quarter, we've seen some remarkable recovery in performance. So I think we are now back in business on performance. I think both the distributors and investors are beginning to notice it. If they're not, they should. And I think so. We now feel that the portfolios are well positioned to get the growth that we anticipate will happen.
Are you gaining market share?
I think we are happy with the market share we have. I don't think we would like to react to market share on every quarter on quarter. We obviously recognize that sometimes you'll have some other funds doing a little bit better than us, and that's fine. It's part of the game. I don't think you can run a business all the time by looking over the shoulders at what others are doing. We respect competition. They always tell us we'll try to learn from what they do. We respect them. But having said that, trying to get to every quarter a number that you want to get is not the way you look at it. And I think strong businesses are built by having long-term strategies in place, and that's what we've done.
What he's saying is that don't look at my NAV on a daily basis. Give me 2 years, give me 3 years.
Absolutely. Oh, absolutely. I wouldn't say don't even look at it for 15 days or for a month. And just look at the track record. Just look at last 3 years, 5 years, 8 years. And that's where the most of the money has been made. I know at the short end, people tend to swing with the current fad of this fund, that fund, or this theory or that story. I don't think meaningful money is made by chasing these fads.
And he's saying that on a media channel where we monitor every second.
But that's fine. You look at a channel, you look at an audience which is different, which is fine.
I mean, their markets are made up of different kind of segments.
Absolutely, yeah.
You've got day traders, positional traders, classic long-term investors, and SIP investors. But to be fair to a retail investor, an average retail investor has got one viewpoint, which is in last 5 years, if I put money in gold or in a fixed deposit or a FMP versus equities, alternate assets have given me a better return. Right. Why should I come to equities?
I think the biggest mistake many retail investors do is that they look at the returns or their experience with returns in the immediate past and extrapolate that into the immediate future. And that has historically been proved wrong. So if you look at gold, for example, if you looked at 5-year returns, fine. But if you look at gold as a return in the last 2 years, you would have lost money. So I don't think you can, it's as easy as looking at the last few years and then saying this is what's going to happen in the future. And I think that's what our job is to try and predict what we see is likely to play out itself in the next few years. So I don't think one should look at just an immediate past to look at, and obviously there are different, we definitely look at investors who are at least medium to long term. In fact, we go out and say to people that you should not look at mutual fund, at least equity products, where if your outlook is less than at least I would say 2 years, if not more. So
you're being conservative now. 2 years.
You mean it should be 3 or 5?
No, it has to be more than that.
Yeah, that's fine, but I could say 10 years, but that's not what something people are going to listen.
So if I give you money right now, after 2 years, how much will you give me back? Let me ask you a direct question.
Percentage appreciation.
That's something that will get me into serious trouble with regulators on predicting returns.
Okay.
But no, I do feel that we are a little bit more optimistic about the future. I would stop short of using words like bull market and stuff like that.
Okay.
We do feel that there is a reasonable value in stocks. It's very polarized. It is more about picking the right stocks and having the people to pick them. So that's where we are.